What if I told you the IRS has a legal loophole written directly into the tax code that allows you to erase up to $126,500 of your income from federal taxes entirely? And no, this is not some sketchy offshore scheme. This is a provision the U.S. government created on purpose. Most remote workers have no idea this exists, and the ones who do often assume they don't qualify. But if you can count to 330, you might be sitting on a six-figure tax break. Here's the deal. The United States is one of only 2 countries in the world that taxes its citizens on worldwide income regardless of where they live. You could be sitting in a co-working space in Lisbon, a beach town in Thailand, or a mountain cabin in Colombia, and Uncle Sam still wants his cut. But in 1954, Congress realized this was kinda unfair to Americans actually living and working abroad, so they created something called the Foreign Earned Income Exclusion, or FEIE. And buried inside that provision is a rule called the physical presence test, and this is where things get really interesting. The physical presence test says this: if you are physically present in a foreign country for 330 full days during any consecutive 12-month period, you qualify to exclude up to $126,500 of earned income from U.S. federal income tax. For 2024, that number is actually $126,500. It adjusts with inflation most years. So let's do some quick math. If you're making $100,000 a year as a remote software developer, and you qualify for this exclusion, your taxable income on your federal return drops to zero. Zero. Legally. Now I know what you're thinking. This sounds too good to be true, or surely there's a catch. So let's walk through who actually qualifies, because the IRS doesn't just hand this out to anyone with a passport and a laptop. There are 3 requirements. First, your tax home must be in a foreign country. That means your main place of business or employment has to be outside the U.S. If you're working remotely for a U.S. company but you've set up shop in, say, Mexico City, your tax home is Mexico City. That counts. Second, you have to have foreign earned income. This means wages, salaries, professional fees, or self-employment income you earn while working abroad. Passive income like dividends, rental income, or capital gains doesn't count. This has to be money you actively worked for. Third is the 330-day rule, and this is where most people get tripped up. You need to be physically present in a foreign country or countries for 330 full days out of a 12-month period. Notice I said full days. That means if you fly back to the U.S. on June 1st at 2 p.m., that day does not count. The IRS is very specific about this. A full day means a complete 24-hour period starting at midnight. So those 330 days need to be clean, uninterrupted days on foreign soil. You get 35 days of flexibility. That's it. You can use those 35 days to visit family, attend weddings, go to conferences, whatever. But the moment you hit day 36 inside the U.S., you lose the entire exclusion for that year. And here's something that catches a lot of digital nomads off guard. The 12-month period doesn't have to be a calendar year. It can be any consecutive 12 months you choose. So if you left the U.S. on September 15th, 2023, your qualifying period could run from September 15th, 2023 through September 14th, 2024. This is actually really helpful because most people don't start their nomad journey on January 1st. But it also means your first year abroad, you might only qualify for a partial exclusion based on how many qualifying days fall within that tax year. Let's look at a real example. Say you're 28, you work remotely as a UX designer making $95,000 a year, and you decided to spend 2024 bouncing between Spain, Croatia, and Vietnam. You left the U.S. on January 5th, and you didn't come back until December 20th. That gives you well over 330 foreign days. You'd file Form 2555 with your tax return, report your $95,000 of income, and then exclude all of it from federal taxation. Your effective federal tax rate would be 0%. If you'd stayed in the U.S., you'd owe roughly $14,000 to $16,000 in federal income taxes depending on your deductions. That's a 15-grand swing. That's a year of maxing out a Roth IRA. That's 6 months of living expenses in Southeast Asia. That's real money. Now, there are some important caveats you need to understand before you book a one-way ticket. First, the FEIE only applies to federal income tax. You may still owe state taxes depending on which state you left. States like California, Virginia, and South Carolina are notorious for pursuing former residents. If you lived in one of those states, you need to formally sever ties, which means closing bank accounts, changing your driver's license, and making it clear you have no intention of returning. States like Texas, Florida, and Washington have no state income tax, so if you're leaving from one of those, you're in better shape. Second, self-employment tax. This is the big one that nobody talks about. The FEIE excludes your income from federal income tax, but if you're self-employed, you still owe self-employment tax, which is 15.3% for Social Security and Medicare. There are ways to deal with this, though. If you establish residency in a country that has a totalization agreement with the U.S., which is basically a Social Security treaty, you can opt out of U.S. self-employment tax and pay into that country's system instead. Many popular nomad destinations like Spain, Portugal, and Germany have these agreements. If you're a W-2 employee of a foreign company, you generally don't owe self-employment tax at all. Third, you need to actually live somewhere that qualifies. The IRS defines a foreign country as anywhere outside the United States. That includes pretty much everywhere. But there's a small gotcha. U.S. territories like Puerto Rico and the U.S. Virgin Islands don't count as foreign countries for FEIE purposes. Also, Antarctica doesn't count. I know that sounds ridiculous, but the IRS specifically mentioned it in their guidance. So if you were planning to spend 330 days at a research station in Antarctica, I have bad news for you. The fourth thing to know is that you don't have to stay in one country. This is a common misconception. The 330-day rule just requires you to be outside the U.S. You can spend 100 days in Mexico, 100 days in Colombia, and 130 days in Thailand, and you'd still qualify. You don't need a residency visa or a long-term lease in any specific country. You just need to physically be somewhere that isn't the United States for 330 days. This is what makes it so powerful for digital nomads who like to move around. Filing is actually pretty straightforward. You file Form 2555 with your regular 1040 tax return. You list your foreign address, your dates abroad, and your qualifying days. If you meet the requirements, you enter your foreign earned income and the exclusion amount, and your taxable income drops by up to $126,500. If you're married and both you and your spouse work remotely and both meet the requirements, you can each claim the exclusion. That's up to $253,000 of income excluded from federal taxes for a married couple. I'll let that number sink in for a second. Now, the biggest risk with this strategy is timing. If you plan to spend exactly 330 days abroad and an emergency forces you home early, you lose the entire exclusion. There is no partial credit. It is all or nothing. So if you're going to do this, build in a buffer. Aim for 340 or 350 days abroad. Give yourself room for the unexpected. Because if your mom gets sick or your best friend gets married and you need to fly back for a week, you want that cushion. There's also something called the bona fide residence test, which is an alternative way to qualify for the same exclusion. Instead of counting 330 days, you prove that you're a bona fide resident of a foreign country for an entire tax year. This one is better for people who have actually settled somewhere long-term. You need to establish genuine ties to that country, like a lease, a local bank account, maybe a residency visa. It's less about counting days and more about demonstrating that you actually live there. But for most digital nomads who are still moving around, the physical presence test is the easier path. Let's address the elephant in the room. Is this legal? Yes, absolutely, unequivocally legal. Congress wrote this into the tax code specifically to prevent double taxation of Americans working abroad. The IRS publishes Form 2555 instructions every year. Tax software supports it. CPAs specialize in it. This is not a gray area. You're not doing anything wrong by claiming an exclusion that the law explicitly provides. You'd be leaving money on the table if you didn't. So let's recap the key numbers. Up to $126,500 of foreign earned income can be excluded from federal taxes in 2024. You need to be physically present outside the U.S. for 330 full days in a 12-month period. That gives you 35 days to come back home. It applies to earned income only, not investments or passive income. Self-employment tax still applies unless you're in a country with a totalization agreement, and your state may still come after you depending on where you used to live. If you're already working remotely and you've been thinking about spending a year abroad, this might be the financial push you needed. The math is compelling. For a lot of millennials earning between $80,000 and $130,000, this could mean saving $10,000 to $20,000 in a single year. That's life-changing money when you're trying to pay off student loans, save for a house, or just build some actual financial security. The world opened up remote work, and the tax code has a provision that rewards you for taking advantage of it. Seems worth exploring. If this was helpful, there's more on the channel. I break down money, taxes, and investing strategies that actually apply to real life. No fluff, no gatekeeping, just information you can use. Take care of your money and it'll take care of you.